Hello, sirs and madams. So our next topic is a broad one. I want to discuss the different options that are available to us within our investment and retirement accounts, such as mutual funds, ETFs, index funds, target date funds, and target risk funds. But before we can simply talk about the differences between these different broad investment categories, there are some concepts and terms that we need to review. So instead of covering this in one exceedingly long video, I'm going to segment this out. Today, we're going to discuss stock funds and some general concepts. The next video will focus on fixed income and bond funds. Then we'll circle back and talk about these broad investment categories here. After all that, we'll put that knowledge into practice and put together an example asset allocation made up of different funds to fit some example individuals. So without further ado, let's dive right into understanding stock funds. And to do that, I want to start by discussing something called the equity style box, otherwise known as the Morningstar category. Now, each fund out there is going to have specific objectives. So understanding this style box will help you better understand the types of companies that these funds are invested in. So let's get right into it. And we're going to start with our three columns. So our left column is going to be the value column. This value column is made up of companies that are considered more well-established. These are companies whose financials are solid. Maybe they have a lot of cash flow or a low amount of debt. And because of the healthy financials, they can often pay a dividend to their shareholders. Because of all of this, they are considered to be a lower level risk compared to growth stocks. And this brings us to our right column. These are growth-oriented companies believed to be undervalued or worth more than what they're trading at, so their share value is expected to appreciate. These are companies that have expansion outlooks, so they may be investing a lot of money into new products or services that they feel will bring in a lot of revenue in coming years. And because they're funding these projects, they may take on debt, they may invest a lot of capital or reinvest their profits into these products and services. So that may limit the dividends that they can pay out. Our middle column is going to be our blend column. Any fund that falls into this blend column should essentially have a mix of value and growth companies, okay? Now let's pivot to our three rows. These are going to focus on market capitalization, or essentially how much a company is worth. So from top to bottom, first we have our large cap stocks. These are companies worth $10 billion or more. These are the largest companies in America, and you may also hear the term blue chip stocks. Our next column is going to be the mid-cap stocks. These are companies worth between $2 billion and $10 billion. They are considered more risky than large cap stocks because first, they're not worth as much, and they may face more financial hardship in times of economic difficulties or financial difficulties. Could be these companies are still funding projects to increase revenue, so they may have more debt and lower amounts of cash flow compared to large cap companies. And then lastly, the last row is the small cap stocks. These companies are worth between $300 million and $2 billion. Obviously, even more risky than the mid cap companies because of the financials that we did discuss. Could have significant potential for having great returns simply due to the fact that some of these companies are aiming for aggressive growth. So now that we have a good handle on this equity style box, I want to touch on just a few more concepts before we wrap up our equity focused discussion. And there's one topic that can sometimes be a little confusing, and it's the difference between international and global funds. First, international funds are going to invest primarily outside of the United States with little, if any, exposure to US-based companies. Now, on the other hand, global funds will invest in companies located outside the US, but typically they're going to have significant holdings in US-based companies as well. So if you're investing in a global fund and you think you're only investing outside the US, I would consider looking further into that portfolio because chances are you still have a large exposure to US-based companies. To dig a little bit deeper into investing internationally, you're going to come across two terms: developed markets and emerging markets. What's the difference? First, developed markets are countries with more advanced economies, better developed infrastructure, higher standards of living. Examples here: North America, the United States, Canada, and Western European countries like the UK, Germany, and then you have Japan as well is a good example. The developed markets are considered in international investing less risky than emerging markets, simply because emerging markets are typically countries that are in the process of rapid growth and development, but still have lower standards of living. So standards of living are still catching up. Examples here are going to be Brazil, Russia, India, and China. These are the most well-known emerging markets these days. And while emerging markets can have significant upside potential, they are considered one of the more risky equity investments you can make out there today. So that's international investing. Now let's say you're somebody who believes in specific types of companies and them being successful in the future. So that brings us to talking about sector funds. These funds will essentially primarily invest in a specific sector of the market. And here's a list of the different sectors that you're going to come across. So let's say you're somebody who believes that technology will only become more and more important to our everyday lives, and you want to look at the information technology and telecommunication services sectors. Maybe you're somebody who believes in clean renewable energy and its importance to our future. So you'll look at the energy sector. Obviously, these funds will be less diversified because of their specific focuses, but it may align better with your beliefs. And speaking of aligning investing with beliefs, we're now going to touch on ESG investing. ESG stands for environmental, social, and governance. This means that these funds use specific criteria to focus their investments in companies that they believe promote environmental protection and conservation, companies that hold high ethical standards, companies that promote and believe in equality within their own corporate culture and structure. For example, here, there could be an ESG fund that primarily invests in companies that are extremely environmentally conscious and will not invest in companies that use fossil fuels in its business practices. There could be a fund that avoids investing in tobacco and alcohol companies, or a fund that avoids investing in companies that have been the subject of severe controversy in the past. Ultimately, ESG funds have become more and more popular and are in high demand today, not only because of the younger generations, but just amongst individuals who want to invest in things that they feel hold similar values and principles that they do. Now, if you were able to follow along today and get a good handle on these terms and concepts, this will be a tremendous help in better understanding what you're invested in and what you should be invested in on the equity side of your portfolios. Now, many of these concepts are going to carry over to our next video, which is going to focus on understanding the fixed income or bond side of our portfolios and the different options you have there. For now, do a little research into your own investments and put this knowledge into practice. Until next time.